We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson here in the studio with Mike Nuss, Trevor Howard, and we're back with AJ Nash, the one and only AJ Nash. Thanks for coming back on the show, AJ. You need to send an email. You're the kind of guy where do you block your day out in like 5-minute increments or what? Like it stresses me out the way you run your life. Like you're just on the run all the time.
I just find if I start every meeting with, I'm so sorry I'm late, and I let the first 10 minutes happen without me so that someone else gets to talk, and then I just step into the room and I don't stop breathing until my message is over, and get a lot more meetings in. But no, I do 15 and 30-minute blocks.
Now you know where I get it.
How many meetings do you schedule a day?
Oh, that's a good question. I don't know if I would say I schedule as much as I touch, but I would say an average day I touch 25 to 30 deals.
Wow.
So I try to get in and out. I try to give updates. I try to give good communication. I try to get my brain around. I try to work 55 to 60 deals at any given time, and I'm trying to every other day at least review, touch, know where I'm at. Some of those you can start to.
When you say deals, you're talking leases, sales,
everything, yeah.
Ones you're investing in, projects you're running, like just any deal.
A lot of these deals are just down the road, right? They're conversations with people that call in that want something. And I just get them on the horn and I say, let me give you 15 minutes of an advisory session. And that's building my pipeline. So I don't pre-book, like I don't take I just ignore everyone and they give me voicemails. And then
I know that feeling.
Call them back when it fits the window. But I've had a fire hose in each hand for probably the last 3.5, 4 months with the extra restaurant duties. And that's been a tough piece, but no.
In terms of your total bandwidth, if you broke it up in a pie chart, how much percentage are you giving to brokerage versus investing in development and running the restaurant and doing the things that you guys are doing? What's your breakdown?
It's tough because I take the way I run the brokerage is advisory. So to me, tax planning, investing, right, deal hunting, that's all still in one bucket. But I would say half of my time is spent every week directly in the combination of brokerage and my own personal investments. And I have 19 partners on projects. So a lot of my clients are partners. Mm-hmm. So a lot of these are just check-in calls. And I'd say that's what I do, with my portfolio clients. I just call and check in regularly, have conversations. And so the pie chart, the restaurant right now, there was 2 or 3 weeks where it was at least 50 to 60% of my work week, but it's now going back down to 20% of my work week.
Is that off and running now, Clink?
Oh, yeah.
Doing good?
It's when the building opens up, I am very optimistic now that
the building is not open up?
You can get in it, but
it's not
our
official.
First floor tenants are not moved in.
Okay.
And so the problem is when there's active construction right when you come in the front door and there's clearly things that are not open.
Yeah.
It isn't necessarily inviting to the public. And then those things that will swing doors, right? When you have a coffee house, poke house, and a dumpling house, those will swing doors. There will be 200-300 people a day that start to visit that building. Mm-hmm. So I would say this, I got to be the host, right? The busser at the restaurant this Valentine's week and the last couple of weeks in February as we worked through some transitions. And it was really interesting to talk to the humans that came in the front door. 50% of them hadn't been back down in 10 years.
To downtown? Or just to that building?
And they had the same comment that, your mom doesn't want to go down there, right, anymore. And I said, well, that's just because there wasn't a reason. But when you come through the front door, this is a reason, right? And they all would smile, right? Yes, this is a reason.
Different spaces activate the building differently. So like the Women's Collective, based on what those businesses are, they have a ceiling to foot traffic. Yep. They're just based on the hours of the day, the appointments they have a limited number of feet walking through the door. When you get bonsai, dumpling, the
day spa, yep.
That has there's no real ceiling to that. It's the buzz that will create the ceiling or the floor. And so that activated space is so key.
So I'll tell you, I'll give you a real answer. Brunch is crushing. So our mimosa brunch is if you're not reserved and you try to come in between 10:30 and 2, you may not have a seat, right? You're a onesie, twosie, we can generally fit you in. But so brunch is crushing. Dinner is growing. Our price point, right? Salem would prefer Black Bear Diner, right? They're not quite fine food. So we still got a lot of Portland travelers that are coming in. And then when we start our lunch, when we open, that's when, so the business is doing fine, but right now I'm 34-hour operational hours a week. I need to grow into 50 before I can be financially viable. And so the toughest part's been I had to shut down lunch because the project didn't launch in October until the project launched until April. So that's when I bring back.
And you're also an owner in the building. Like I
have ownership in the building.
Yeah.
I've got ownership in.
So
yeah.
When you're as a tenant, you're pissed because the building's not open, but then you're pissed at yourself because it hasn't been opened.
Yeah.
Are you pissed at yourself?
Yeah. I went through that. Yeah, I would say the only thing I'm upset on is that I didn't protect myself better as a tenant because I would have had it not been me.
So, meaning write your lease and such that
my rent would not have started
until the building's open.
30 days after the first floor was 85% plus leased.
That's a very fair request from a restaurant.
And at the time, we would have all agreed on it.
Yeah.
Right? If I ask for it now, I'm asking for a handout. But at the time, if I would have told Chris, right, you're supposed to be in October, my rent shouldn't start, yeah. Right? Because we had a grand opening scheduled for August, September. And so my rent was going to start right in October. So 30 days after the building was open. And yeah, it's when I'm realizing rent, if I knew what I did today, I wouldn't have opened until October 1st. I wouldn't have tried to go in July.
And honestly, that's part of the negativity I think you get is that you're not full hours and people don't understand why. And if you can't understand why it's not full hours and you think, well, this is what it is, that's where rumors get spread and misinformation gets spread.
And when it goes that long, you're defining who you are.
Yeah.
Then you got to reinvest and redefine. And so
you almost have to have a grand opening when the building opens.
Yep. And so I would say this has been a much heavier lift than I anticipated. And in large part, it is because of the delay. But having this experience is going to make me a better broker because I've experienced this much pain on construction delay. I will protect every other tenant that I ever represent.
That's exactly how you started the last episode, was you saw underrepresented business owners setting themselves up for lack of success because they didn't understand the long-term implications of what they're committing to.
And everyone had best of intentions.
Yeah.
Right? But they didn't understand, well, what if October 1st doesn't happen and it goes to May 1st?
Yeah.
Then how much trouble are you in? Right? Well, it'll never happen. Right? And I think that's where we were at. I think if you'd ask Mr. Blackburn, I was originally supposed to move in March 1st of last year. So it was already 120 days behind at that point. So we thought October was inevitable. But anyways.
So let's dig into deals.
Yes.
We want to talk deals. This is what gets Trevor excited. So do you have a favorite deal or a least favorite deal you can share with us and kind of walk us through start to finish?
Man. I'll give you, I don't have least favorites. There's so many of them, right? There's so many of them.
Is there one that kept you up at night?
No. To me, it's all just business. I don't get too attached to them. And if you have one or two deals is when you stay up at night because if it goes sideways, how are you going to put food on your table? When you got 30, you just get used to understanding. A good one, JCPenney's. When that one went, that one hit me hard.
And you were going to be buying that with Nat, or you had
Nat was going to be buying
involved?
it.
Okay.
I think Chris Blackburn was potentially going to be a partner with Nat on that. But that one hit me the hardest. It was my least favorite, just because that was the first one that really market conditions were a big part of our crystal ball. And when they did not line up and when the city permit issue and the opening of the forge didn't line up, it was tough because when we got into the deal, it felt like it was a lower risk than when we got to the backside of it and looked backward. We're like, this was a lot higher risk than we
thought it was
at the time.
Yeah.
And we still executed on just about everything we did, but the value of that 4 to 6 months, again, just like opening the restaurant, that one hit at the same time. But no, my favorite new deal. I'll give you my favorite new deal. Hopefully Mark Frazier isn't listening to this one, but that's all right. I like that guy.
Should I tag him when we...
No. Woodburn Medical Clinic, New York, New Jersey, Delaware ownership, REIT, right? Had some goals they had to hit, didn't know what they signed. I mean, it was a fun deal, but long and short, Legacy Medical was moving out. They did not want to own it if Legacy Medical wasn't there. They bought the building for, I think, $7 million. I came in and I was told it would never go a red cent under $5 million. So we wrote our first offer at 3.9. We ended up playing hardball, probably 4 rounds of back and forth. Got it under contract at 4. Ended up closing at 3.7. So as I was in due diligence, lined up a 15-year lease with a pediatric dental clinic as a partner too. So both an owner and a 15-year tenant. We were able to underwrite it under medical financing because it was a doctor group that was moving in as a group. We secured in August 4.95% interest and a $2 million construction budget because of the medical folks that were a part of it. So my favorite part of this deal was we bought it right? It went for $7 million. We got it for $3.7 million. We landed the anchor tenant before we were out of due diligence. And then we secured debt that I didn't know was possible. Like that was we brought 1/3 of the cash we thought we were going to bring to the table to close. And it was still a good deal with all the
Where'd
cash.
you find that debt?
Through the operators. So I have access to now different channels than an investor pool. That debt is doctors only, and it's with clinics only that are doing certain business plans, right? And so having the dental office and the dermatologist allowed us access to this capital. That Bank of America is the first time I'd used Bank of America, and I mean, shoot, 8-10 years.
Yeah.
They were off my map.
Didn't even know they did real estate loans.
I know, me neither. Would have never thought of that.
So we closed in August, and I think we'll sell in September. And I think we're looking at about a 100% cash on cash return, maybe 140% in 1 year. So,
Yeah,
That's pretty good.
So how did you find this deal? Was it just listed on the market, or you found it through
It was
prospecting?
listed on the market, and it was 2 folks that I've had a long-term relationship placing medical, and just send it to the derm. He said, yeah, let's take a run. How low can we get it? And I said, well, it's a REIT. They're going to throw a fit, so just stay strong. And he's a smart dude. He knows what he's doing. So I like it. He actually, normally I have to be the bad guy. This guy's great at being the bad guy. So he underwrote it. I underwrote it. They didn't want to buy it unless we had the tenant. I went and found the tenant, and that's the magic sauce is finding something vacant, buying it right, and then finding your operator before your due diligence, because then that limits most of the risk.
Yeah, so your whole plan was placing that operator before your DD ran out.
Yep.
And then you were just confident you could find an operator and there was enough out there for it?
Yeah, just like Chris, when I'm dealing with Chris Blackburn at the Forge, I'm just like, just trust me. It's what I do. Mm-hmm. Right? Like, I'll do my job. I'll go get a tenant. And you do your job. You see if your derm clinic can go in here.
Yeah. So why do you guys want to sell it versus like refinancing, recapitalizing, holding it?
That's a good question, but the cash on or your return goes down every year you hold it.
Yeah, your return on equity is just decreasing.
Yep. And so you can eat equity. You can do rinse and repeat, which is a business plan, right? Are we okay holding this? Absolutely. If the sale doesn't go through, are we fat and happy? Absolutely. However, if you can put, when this is all said and done, if you can put about, we probably only put $600,000 into this deal and take out 1.6 to 1.8 in 12 months. If I can keep finding, so the only reason you would keep it in is if you're not good at deal flow. Mm-hmm. And my deal flow is high. And so the velocity of deals I get to look at every single, and when you start to align with medical owner operator looking to scale to sell to a REIT, and once he hits 20 locations, he's maybe sitting at 8, maybe sitting at 6. Most of these operators have their own PE exit plan. Mm-hmm. So where I'm trying to find my fit is find the guys that are looking for markets, find a couple of them that can collaborate in a market, This group, right, the doctor of the derm clinic is kind of like the kingpin of some other doctors that, he's assembled, he's young, and he's willing to like say, hey, I can put these 3 types of uses, and he can fill it. And so he actually adds value beyond money bags because he helps with operator assembly. And then I just do deal assembly, so strategic creation of terms. And the toughest negotiation part with the multiple hats is when I negotiate, it's not like when you're buying a deal. Because when you're buying a deal, you're buying it right and pitching your plan. So when I negotiate, I've got to protect the tenant hat on against the landlord. And then I got to switch it off and got to protect the landlord against the tenant. And there's often intersections where those 2 things don't align. So I am at least 30 to 40% customer service.
Okay.
And that is balancing not a adversary or we have to be cooperative, but there is competitive interest. So how do you explain?
Yeah, because you're doing the sale leaseback and they're staying in that space for long term, and then they're occupying more spaces with you, you're saying, and you're trying to repeat this over and over?
So in the end, to represent the tenant, well, I required a purchase option. That was a tenant request. That we weren't seeking that as an ownership group. And they had to have a right to, if they were going to be investing at this level, and for 15 years, they had the right to control their destiny and not, right? And then what happened was, as the deal came full circle, and there's, let's call it some common area expenses and some other things that come up, you just start to look at, well, if I could get that cash back and do it again versus set it, forget it, and let it start printing, cash flow versus active growth, getting 140% cash on cash return. I mean, that's how many years of
cash flow on it.
So what I look at is just like, well, great. You got 7.5 years. We could wait to get the same amount of cash. We'll take it out whenever we want. It's like that cash isn't gone. But if you could spring forward 7.5 years of cash flow today and then redeploy it in the next piece of deal flow, why wouldn't you?
Are you talking about how you justify then? Because you're saying you're representing a tenant, but you are also the owner. Is that what I'm hearing correctly? And as owners don't typically want to give rights to purchase.
So even though I was the owner, I was minority. So I would argue I was just similar to the tenant. But yes, the primary 3 doctors that were buying this would love to just get their money out, let it print, and do it again because they're building their wealth, right? And that's still a very viable option. And there's actually different ways to carve that pie on the exit. We haven't gone through the exit exercise. But as I give an exit exercise to the dentist group, I tell them, the longer this goes, the more they're going to want you to pay full price. The faster you buy it is going to be the better price.
And that's the tenant.
Yeah. And so we want to find a way to goose the owner just to give you an option. Like you could just literally be a tenant and enjoy your minority ownership alongside of my minority ownership. So I'm letting the tenant control their destiny. I'm not trying to coach them anywhere. I'm just saying your optionality is just get comfortable. You're an owner, or get more control, right? And get the faster you go, the better the price will be. Because if they're saying I had 140% return year 1, cash on cash, versus year 2, it becomes, right? 70%.
So you're incentivizing them with lower strike prices by executing sooner?
And I don't even communicate the incentive.
Okay.
I'm communicating motivation. So I just say...
This is mindset conversation.
It's just mindset. I'm just saying that a seller, like me as a seller, if I put my owner hat on, if I can get out sooner and get my cash sooner and look at this over 100% return, it's going to give you the most leverage to come in at the lowest price.
So this is a guidance conversation to your tenant as you're coming up with a pitch to your partnership group as the owner.
100%. And then when I go back to the partnership group as an owner, I just say, well... here's the optionality. I can discourage them buying it year 1 by just telling them price is too high. Or I can open the door for them to make an offer if you're willing to understand that the current cap rates are probably different than what they're going to be in a year and a half, right? And it's just risk and it's just time. But the way I wear both hats at once is I show optionality And
well, you also understand both
positions. And then if someone's closed off, I say, well, they're pretty closed off to this right now.
And I love that discussion, because if you understand both positions and both positions have optionality, you're creating overlap. You're artificially creating overlap and lack of overlap. And so now the options are kind of forcing themselves into a zone of agreement. And then now you've limited your options by overlaying each other's options together.
And the way I use levers, like estate planning attorneys use buckets. And I tell them there's no reason for you to do all this work if none of these levers aren't moving in your direction, right? Or if none of the levers are moving in your direction. And so the reason you would, let's call it move your time up, is if you move the price down. And if not, there's no incentive. Unless it's maybe control or a write-off that you want to go talk to your CPA. But and maybe the pitch, here's a good example, and this is still on the table, and I've pitched it to both. I've said one of the pitches is just invert positions. So at time of refinance, buy more ownership. Go from minority to 70, 80% owner. Keep the docs in with 30% of the upside. So they get some of tomorrow. They get all their money back and some of it today, and they get some of tomorrow, and you bring $0 additional cash by keeping the equity in.
It's like a PE structure almost.
Yep.
Yeah.
So creative finance, I think, is my favorite part of the gig. Why it's my favorite deal is it allows me to shine in the areas I shine in deal assembly, not just identifying opportunity and getting an operator, but more importantly, strategically planning the exit, the timing with two partially conflicting views, right? Seller wants highest price, buyer wants lowest price. Clearly a conflicting, right? So then how do I put both hats on, look them in the eye, and give them a path as to how we reconcile that, right? Well, time and money are the top two variables, and then risk, this other piece of risk, right? And then comes the sooner, so I said right now, just mentality in general. When you've been getting that check for a year, you're less motivated than when you haven't received your first check yet. So I said part of your purchase leverage is to try to get this out sooner before they're used to getting the check, right? Before we get
before their motivation dissipates.
Oh yeah, or changes, right? And until that, the Fed has their adjustment, we go down 2 points, we get long-term debt at 3.5% again. Probably not going to happen in any of those categories, but
oh darn it, you got me excited.
But I love it because then, and part of this is greedy broker. I'll be very open. If that cash comes out, I get to do another deal. And if cash stays in, the velocity of my deals goes down. So, but I try to communicate very upfront to folks like, hey, I'm a broker, so I of course want you to get this return and tell you it's good. You decide if 140% cash on cash return is good in 12 months. You decide, not me. But if that cash comes back, I get to go do another deal. And so the addiction to the deal, the addiction to the deal assembly, but it's all creative finance.
It's really, you have to do a good job of really not even just understanding, but showing you understand your own self-interest and motivation, and how that also contradicts against both of the sides that you're being a collaborator with, because that creates the safety and then the trust to say, oh, well, yeah, that is in your best self-interest, and you're letting us make the decision. I think it's like calling the elephant out in the room.
So it's funny how you keep mentioning creative finance, because most brokers in your role, like, you say those terms and they just go the opposite direction. It's like when I was brokering, then I would use the term creative finance, and you're with the typical broker, like conventional cash sale. Like, we don't want to think about this any other way. And we've done, I don't know how many deals creatively where there's some different aspect to it. So how did you get to the point where you like that? Because most people in your shoes are just like, just typical buyer, cash, I want it simple.
That's an easy answer. This is a forced learn, because when you're not from the area, new to an industry, the types of people that will work with you have the hair that 3 other brokers haven't solved. So my entire skill set came from a requirement. I had to learn this to solve problems that conventional wisdom and opportunities can't solve. But then I guess the secondary piece is when I learned how much this plays into tax benefits, because the one common enemy that's easy in every room, buyer, seller, tenant, landlord, is Uncle Sam. And everyone can rally behind getting, right, Uncle Sam. But I think creative finance in certain realms, especially in multifamily for a while, was a 4-letter word that no one wants to talk about because all it meant was seller carry. It was synonymous, right? And I think for me, that's not what it means at all. That's one of the 7 or 8 arrows in my backpack. But my favorite set of creative finance that I'm using and deploying regularly, like a lot right now, is structuring a purchase within a sale. And, sorry, within a lease.
Yeah.
Within a lease. And so we would call it lease to own. But I'm even working on some big land development deals because you can't get debt on land, right? You need to show beneficial control, whether you're applying for, public grants or you're just a private developer looking to go control your destiny. And what I'm using is just an amortization schedule, 25, 30 years, and so one recent deal, been on the market a while, a 5-year lease. They'll generally take a lease.
Yeah.
So I don't start with creative finance. I just start with, would you take a 5-year lease with an option to purchase? And they said yes. And then I say, great, we're going to define price now. And then they're like, well, we don't want to do that. But what I do is I put an amortization schedule, an interest rate, an equity pay down, and at the end of, there's one payment for 5 years, no escalations. There's equity pay down, so with the note is that the price is already defined.
Yep.
I demonstrate that they're getting about $1,500 more a month than what they would for a standard lease, but also they don't have to fight to get their property back. They don't have to go through any jurisdictional process to get their name back on a deed. Their name was on the deed the whole time. All there was a leasehold interest. If someone doesn't perform, it just goes away. And so the downside risk of non-performance was the toughest sale back in the day when I was working alongside of you and Paul, right? And this model of master leasing has allowed me to take full control of projects without having to come up with any cash.
Yeah.
Very little cash.
Yeah.
And it also eliminates the broker conversation for big fees. So I'm still in a fee in 5 years when we sell, but my leasing fee, and I net it out like any unearned leasing. If we buy it next year, it comes off the sale commission. I'm not doing this for big commissions, but it takes a commission fee and it shrinks it probably to a third of what they were expecting. It gives my client control. It gives, and it gives an exit point though, right? For the person that was hedging, I say, great news. If they don't perform, you get to keep the property. You have to keep the property. Yeah. Your biggest risk here is they decide not to buy it. They say, keep my equity.
Yeah. The lease option is interesting because we were looking at those on a couple multifamily buildings, and my understanding of how the depreciation works on it is really interesting because if you're leasing it as a buyer, you can in some instances still take depreciation if you're building equity within it or if it looks kind of like a seller carry in those cases. But if it's just flat rate lease and an increasing sales price to that market rate in 5 years or whatever, then you're not getting to take the depreciation. So like the structure of it.
Yeah, the docs in a land sale contract and a master lease with option to purchase are almost the same document.
Just got to paper it correctly. That's what my CPA says. But yeah, there's a clear path where some of the depreciation benefits are there. I would argue when I pitch it, I say that one of the things you lose is some of those depreciation benefits may not be the same as what they were. So this is a tax play. But what's interesting is creative finance is seldom a tax play. Creative finance is often a low cash play.
It's an acquisition strategy.
And the low cash play, right, is often mid-30s through mid-40s, right, the growth part of their career, or they're making more money with their cash in other segments than they would be parking it in real estate. And that's another piece. I mean, shoot, I've probably done 100 of these, but my favorite deals are when the rinse and repeats in this industry, where when you take something vacant and you buy it and you put a tenant in, and that income approach performing asset now allows you to remove all your cash in less than 12 months. And so your cash just goes in and out. You get all your cash back and you keep your ownership. And that was kind of my target deal for a long time. Yeah. I didn't get into any of those, but I helped. I mean, we used that with Chris Blackburn at least 10 to 15 times, right? Very successily.
Yeah, it's a really cool play because you can convert it so quickly by just placing that income and then valuing it off the income approach. Yeah. So like it's because the value of the building becomes very little to the person who owns it without a tenant, and now it's a headache a lot of the time, especially if they have debt on it. And then you just get to step in and pop value right away. And especially with your relationship with all these leases and knowing what tenant's going to go in there, like I couldn't go do that because I'd be like, who uses this building? Like I have no idea.
Gotta have AJ.
Yeah.
But that's what's interesting is a lot of people say you just stop doing leases and just do sales. And when you're in investment real estate, leasing, having a pulse on leasing is the most important thing to my job. Mm-hmm. So I refuse to give up all the leasing. I still do.
That's the smartest statement.
20 to 30 leases a year, to just stay in it. I am touching a lot of them, right? I'm seeing every lease that's happening and giving counsel to my team, but I still have to get in there and wrestle. Partly, I don't want to lose the skills, but partly just to know where the market's moving.
So how come you don't just focus your personal investments on like that and just repeating that as many times as possible? Because you can create millions of dollars worth of spread very quickly. You know all the industrial and retail buildings. You know all the tenants, and you could just go all in on that.
Yeah, I think it's because I'm not really motivated by making millions of dollars.
Yeah.
I'm fortunate my wife isn't either. Right? I mean, starting a restaurant on our own without a partner was asinine. And starting a farm, like those two things, we were told by every financial advisor in our life, don't do it. But that's from a financial standpoint, right? Yeah. And I was like, babe, how cool would it be? Like when we get older, like I don't really care if we have to rebuild some money to launch a restaurant, to like carry out this vision, to bring this to life and solve this project that could be a pinnacle to changing Salem's future, right?
It's a maximally productive lens.
Oh, and I said I wanted in my blue sky, she gets to have her lair upstairs. I get to have mine downstairs. I get to be a coach and a mentor. We get to be in the same building, and we get to be the epicenter of the spark that helped bring Salem back. And I was like, all right, that's a purpose part of life that excites me more than millions of dollars. And I don't know. I find that there's actually a lot of people in this room who are chasing money. I still admire. I think you do it for a lot of the right reasons. But I find that as U.S. entrepreneurial souls, we have placed too much money or too much value on the dollar, the almighty dollar. And we have not placed enough value on lifestyle, on community, on the rising tide that rises all boats. And I would argue if we look forward in 5 years, one of the things that could take all of our real estate portfolios, yours, mine, all my clients, up, is making Salem so desirable, so innovative, right? So fun that people want to be here, because all real estate value is net inward migration or net outward. That's it, right? And if we create the mechanism for significant net inward migration, I think that we're raising the city's value. And for me, I look at this like the city as a whole. If we can create equity that can be leveraged in a group of people willing to grab it and leverage it for common good, common gain, common growth. Shoot, right now I'm ready to launch a cider line with Chicha that's called Make Austin Jealous. And I want to tag Austin in it, and I want $1 for everyone sold to go into this little fund.
For everyone from Portland, they'll respect that comment.
But what I want, though, is I want the promo for like the entrepreneurs to say, wait, did you hear there's this fund we can go look at? And then I can create the grants, right? For them to start their business. And it really doesn't take much to ignite the youthful soul in capital.
One of the things you guys are doing, and I don't know if you pioneered this or not, but we were watching you when you did the Forge, where instead of just let's come up with a new idea and go find new tenants, you actually wanted your tenants to partner with you on the building and be investors in the project. Is that something you guys learned somewhere else? Were you the architect of that? How did that come about? And it sounds like you're kind of doing that in some of your deals now, where you're leveraging your relationships with an owner operator to go into a deal with special financing. You're partnering with them on that deal. Where did the thought come from that we don't just have to own the building and segregate building ownership from tenants? We can actually pair that together for success.
Yeah, no, it stemmed with syndication. And in syndication, we had already created the mechanism in the vehicle for, A-share, as we call it, investors to come in and be a part of the investment structure. And then when leasing had a few larger spaces that were there, and there were some like conversations around specifically, there was a restaurant that was going to move over, and they wanted $500,000 to $600,000 for a build out, and our budget was going to cap out at about $250,000. I said, well, how about this? If you were to bring $600,000 in new cash, we could give it to you in ownership. We could do a dilution to where the cash is at least there. So you're bringing the cash. We don't have it leveraged in, and we would dilute to grab you. And if you want to be a part of the ownership pool, I think we could double dip with those TI funds so that you don't feel like you're losing it all, right? That you're investing in our building, that you're investing in yours. And so that's, I think, where it started, was just a creative financing conversation, trying to learn the tenants' needs, trying to figure out their hesitations. But right now, my dream, I'm going to probably be coming out in May, June at Clink with a Green Bay Packers style community owned deal. And what I've learned is, especially in these high stress businesses or things like restaurants, right? One health impact in a human's life can take something down. One divorce, one bad year or car accident, like take your pick. And if there was this pool, and I would be willing to be the biggest initial investor in that pool, that helped, like if Clink was community owned, 50% of it, right? And it's passive. Well, then all of a sudden you got a restaurant group. What if we, bring Cozy into this, bring 2 or 3 more restaurants? Why? Because it's community owned, and that community is bringing in that new life. And so it is such a heavy lift to do it all on your own, and it is so hard to paper it correctly, SEC and beyond, to do it as a collective, that I'm learning it's not about people's unwillingness to invest. It's about lack of opportunity or being asked. So we'll see if this takes flight, but my goal is to have Clink specifically, but then also the Forge be a community-owned asset. And if we had a community-owned downtown instead of a trust-owned downtown, you know what I mean? It's
like a co-op.
It's a co-op. A capital call isn't, oh my God, we need $400,000 for the elevator. It's everyone needs to pitch in $4,000. Mm-hmm. It just is. It's a lighter lift, right? And
well, now you have 100 people telling all their friends and family why they should go down to town instead of 4.
Yeah, there's a marketing component, but I think the leg of the stool that is the toughest to motivate is the capital tank. Capital tank always chases dollars. Dollars always wants returns. Returns drive down long-term value, because short-term value, you can get a greater return than long-term value. Mm-hmm. I always laugh. I tell Chris he's got a 3-year business plan. The 5 and 7-year business plans don't get the money out for 15. The 3-year business plans get the money out in 3. And there's such a focus on the dollar right now that the 3-year business plans are where he should be spending his time. And I like spending time there. But I want to spend more of my time in the 5 to 7-year and 15-year legacy plans. And that's,
how do you balance that out? Your soul wants to look at a 15-year time frame, but financial feasibility and liquidity and overall impact work better in a shorter time frame.
I think it's just this community-owned aspect. I think it's a lighter lift if you've got 50 people, right, or 100 people in a community that say, let's make Salem stronger together. And there's a lot of people that are out there trying to do that, but what does that mean, right? This downtown group, this association, this. So my thought is, well, make a buck when you invest. Don't give it away. Like, let's plan to make money on it, but let's take risks in areas that others don't. Some call it angel investment. Some call it seed funding. But I think the best way I could use my skill set and to be the most valued would be to create that community-owned fund and help sell that community-owned fund, not for profit gain, not like what you're doing with the real estate side, but with people who say, let's go get good food in Salem. Like, that's a different return metrics.
And you're talking about an unsecured fund, right? You're not like a land trust, a community land trust. You're saying this is a high pool risk. Of liquidity, high risk. This is getting invested in storefronts and businesses and operators.
It's a community angel fund.
Yeah.
Yep. Let's all throw in 10 grand or 100 grand or whatever the number is, and let's go make Salem better.
Hire some private security, hire some whatever it needs to be done this fund can then now go put money where it will help everything in the downtown core.
So I like that comment, sure, but I would say no, in my opinion, to the addressing the negatives at this point. Mm-hmm. I would say yes to fully investing in the positives. And what's interesting is someone like my wife and I in Clink, if we do not, let's call it add a partner or bring this on, we're probably idle, standing put for, let's call it at least 5 years, right? But for this investment for us to like recover enough to take another big risk. If, let's call it half of our capital tank was returned and we went community-owned asset, that would allow us to start the next one relatively sooner. And so the entrepreneur's capital tank ends up being an issue. The entrepreneur that we invest in are the humans that like change culture. And so that's leading back to our first podcast. My hope would be to create this group of angel investment that say, not let's go tackle homelessness. That's a different bucket. But what you could say is let's invest in a mural wall in Electric Alley to increase positive pressure. Because if you have positive pressure and people reviewing it, then guess what? The negative pressure gets pushed out. And so I'm tired of managing negative pressure. I would like to start building positive pressure.
Dude, such a refreshing mindset. And what I heard you just say is you're willing to take away from your 15-year future and what you've built and give it to the city in a way to expedite the community aspect of what you've built.
Yeah, and it would be I believe we can build the community faster if we invest in operators and dreamers and visionaries. I believe that my wife and I have proven that Clink is an example of that. Mm-hmm. And I think we would move faster to do it again, or we can incentivize other people, right? Like the bonsai folks to do it again.
Do you already have an idea of who is worth investing in that aspect of like, hey,
100%.
Yeah, you've already identified.
When you have 90 listings in an area, you take calls from everybody. And the amount of calls from operators over the last 10 years that we've taken and vetted and invested time in, we know who performs, who doesn't. We know who's innovators, right? And what's interesting is there's this other group of infrastructure that's landing right now, and I'm partnered with them, we're going to start getting into the business succession planning and dispositions. But this group is entrepreneurial. They want to be on the acquisition side and then the operator side. And so they're working on a locally owned business group that has, let's call it CEO and general managers that can be plugged into different operations that can help with the scale. It's kind of like the M&A path, but with the intent of staying local with the knowledge that the local operator doesn't have that infrastructure to know even like where the target is and to do your business disposition, business acquisition, but more importantly, business growth, business planning. Mm-hmm. And so now comes how do we get Salem more educated? I think that's if we're more educated, we can do more, right? And a group like that could come in and potentially operate this fund with people to plug into different places. And I think we've identified a lot of folks that can perform right now, but I think there's also, we're just on the beginning of like getting entrepreneurial energy back in. People were just discouraged, right? Mm-hmm. Back in our city. And I love speaking to the high schools because they're full of it, right? It doesn't take much to motivate a high schooler to feel entrepreneurial. But I can already see that. We had a party last night with Jacob Espinoza, right, with a bunch of, I think, 80, 90 influencers out there. And when you see that room, I was like, I love that I don't know most of these humans. And that they all have followings in different areas, and I have no idea. It was exciting to see that energy, right? Just like what you're doing here, right? Just people getting out, spitting positive energy, creating teams.
Yeah. Let's break down the deal you guys did together.
No,
yeah, man. I don't even remember it.
Yeah. That's how most of the deals go for you. Yeah.
What did we buy, AJ?
Oh, God.
As long as he had fun, that box was checked.
So we went under contract right before COVID was announced.
I mean, yeah.
Condition removal was...
One of our first meetings was like, the world just shut down. Should we kill this deal?
Totally. We had not closed yet, but we'd removed conditions right when COVID was announced and the shutdown happened. And we put $400,000 in cash in. We had a carried note on the balance. We had a general contractor that
We didn't even need that $400,000. Actually, we put that in a kitty just for
part of it was a buffer.
for capex for buffer.
That was part of your down payment, part of your buffer, or that's your DD?
$4 million deal. The credit union was willing to give us $3 million. The seller was willing to go into second position at $1 million, and it was just under. I think we had to go like 299 on our first in order for it to not have to go to the board or the credit union to approve it, and they allowed us to have the seller in second position. So we fully levered into a 36,000 square foot retail strip center in Vancouver, something like that.
So
38,000.
$100 a
It's like
square foot.
26 units, I think.
Yeah.
You know this. You know the property way better than I do.
There's 22 units. Yeah, a restaurant. I think you're pretty close on the 36,000 between both buildings, two buildings. And when we got it, the upside was the rents were about half of the market rents
with
around.
no triple nets.
Yeah, there was no triple nets in place. They were all modified gross or gross
Were you
leases.
buying it based on the in-place cap rate too at that $4 million price, or
Yes,
a little compressed? There was so much upside.
It was probably 6.25 to 6.5 at the time. So
what is that asset typically? What range?
I mean, there is no typical because it's all based on the leverage you can get. So I would say we were about a half point under where it would be trading because of the upside in cap rate. It cash flowed day one, but
with that debt,
with the debt. However, there was a lot of month to month, and there was a lot of TIs. We knew it had to have a full reskin. We knew it had to have new signage, new parking. We knew that we were going to have to touch most of the rehabs to get what we wanted out of it. So I think we overspent. I mean, not really, but we probably put 1.4 into it.
I think we planned on about $1 million, 800 to $1 million in the beginning.
And we levered up again just in the nick of time.
That note, the seller note, was coming due in a 2-year time frame, so we had a very short runway on the second.
Okay, so you were just trying to place new debt at that time, increase value, place new bank financing.
And we pulled off, I mean, I give
it was magic.
AJ gets all the credit for this. We pulled off an incredible loan with the same lender who had given us the first had moved to another bank, and they stepped in and helped us get
what was the holdup with it? Just getting the rents up in time to
part of it was the rents up in time, and then part of it was the economics were adjusting. So let's call it 2022, 2023.
Interest rates just went up, and now you don't
interest rates were flying up.
Yeah.
Like we locked in at 5%, and 2 months later you couldn't get something under 6.
Yeah.
Like we were 3 months behind the 5%.
I mean, we were probably 2 days away from a half a point increase if we didn't sign on that loan.
So, but yeah, that project we were able to keep probably 25% of the tenants in place. We replaced 75% of the tenant mix during COVID.
Wow.
You can't go from 50 cents on the dollar to $1 on the dollar and keep tenants. So we had to go 70 cents on the dollar, right? Do conversions to triple nets built 3 years down the road. So it took 5 years to do our 3-year plan because of the economic conditions. And then we disposed of it this year, and we sold it at a 7 cap, but we converted 100% of the leases to triple net, and we got the revenue in a place where so we got into it with 0, but we put 400 in. And I think we took
we still had some left over in the kitty.
So you guys, and you got at that 2-year mark, that bank financed the rest of your $1 million spend to do it.
There was myself and Rich Duncan ended up keeping some prom notes on the books so that we didn't have to clear out debt, so that no one had to bring cash.
We partner with a contractor, so we were using their line to do TIs and stuff, and then the agreement was to pay them off on the back end, refi or sale.
And then we rolled our leasing commissions in, so we didn't bill. We rolled those in.
Just for ownership.
I will just say something about that deal. I don't know why I was the partner still. We sat in a meeting once, and we sat down, and everybody was trying to talk themselves out of the deal, and they came around to me, and I said, well, I only have 2 things to say. One is we have to do this deal, and number 2 is I don't know why you want me as a partner. And they're like, well, that's why we want you in this deal. I mean, the deal was great, but I have to say it was the partnership that made it great. Having AJ's brain and Rich Carlson doing all the leasing, and having the Duncan team do the TIs, and being able to float some of that construction until later on and carry that. Like, I don't know that we would have pulled that deal off if it wasn't that group.
it would have been a lot slimmer on the margin side.
Yeah.
The group was very collaborative and definitely deferred some collection, right?
Yeah.
So there was some lines used. Now we paid 6% on that money, so it wasn't, forgiven.
Yeah.
Right.
But you carried commissions through you re-tenanted almost the whole building and took your commissions at the time of sale.
Yep. And we do that a lot right now with partnerships just because it's cash skinny. But yeah, I think at the end of it, we put 400 in. We never really had a capital call. We had a scare one once.
Yeah, I think we still had almost $100,000 left in the kitty, and then we sold it for 6.9, and
so we ended up pulling, I think, 1.85 out. So you can do the math on that. It's about the 4x return on cash. But yeah, no, there were moments though when you're trying to get that financing, when you're tearing things apart and you find $150,000 worth of problems you weren't expecting. It's the same thing that we do on any deal.
You talked about a little while ago, you were talking about looking in the rear view and seeing that there was more risk than you thought there was. When we sold that, I looked in the rear view and I thought there were some definite risks there that I didn't see. Like it was a much riskier play.
Just from opening up the walls and finding all those things.
Not only that, but just the market cycles and being in retail and having to re-tenant that whole thing and go through it. I mean, there was just being in that asset type in an area. I mean, luckily for us, I think Vancouver was a really good market to do that deal in. I don't know that you could have pulled that off anywhere in Oregon. So there was a lot of things that lined up to make that actually work. But the margins for the risk in reverse, if you were to start over on day one, do you think we'd do that deal again?
Well, I mean, knowing how it ended, of course we would. But I would say this, that if it was 6 months later and COVID was full steam, we wouldn't have done it. Like a lot of that stress came from COVID. Mm-hmm. A lot of that stress came from managing unknown and massive change and massive interest rate. But when you look at getting into a project when interest rates were
3 or 4%,
3%, and then exiting, right, when cap rates were 5.7, 5.6, and then exiting when cap rates are 7.5, and you still
make money
4x on your cash. But the biggest issue is when you 100% lever into anything, then if the note comes, if the market pressure, so when we were getting to that loan, it was like, well, how are we going to come up with $1 million?
Yeah.
That was we didn't know. Do we have to go renegotiate? Is she willing?
Yeah, because it's pretty cool to
beg for mercy.
Well, levering into a deal at 100% that cash flows day one is pretty hard to do with that much debt on it. And then your risk, it sounds like, was that 2-year note period, which you had to plan for. So that bank at the beginning, did they give you a 25-year AM on that too, in that retail space? And then how did you get them comfortable with the second? Because usually they'll look at that and not want
DSCR.
It just covered still.
And lender relationship.
Yep.
Who'd you guys do it with?
Same guy who was running the credit union that did the first for us had moved to another bank, and he moved out of state, but he was trying to bring his bank into Oregon.
MAPS Credit Union, and they took a look at the operations. So they took a look at what's your plan.
Yeah.
We're going to re-tenant it. Real estate owners or partners. We're going to construct things. Rich Duncan is a person at their bank with a credit line big enough that his signature probably mattered the most when we were getting into this to MAPS Credit Union. I think mine mattered the least. One of the things you brought, right, was a different level of ownership. Mm-hmm. At the time, this was my first it was my second investment. My first one happened in October before this one, and it was at 675 Orchard Heights. And I would say that's the hardest part to getting into this game was rat holing that first $25,000 or $30,000, right, to just get into the game. And this 100% leverage was very attractive because it allowed me to get into the game at a different level than I was currently in. That's just the hardest part of this is getting started. Like after you're started, time flies.
Yeah. I think it sounds really cool to people that lever at 100%, but they don't realize all the risk involved from a cash flow perspective once you do that.
Yeah.
And especially with the 2-year note, that's the part that scares me.
The short runway in reverse. When I look at it, I go, man, we shouldn't have gone into that with that short of a runway. We should have had something baked in to go.
Yeah, 2 years sounds so long. What are you talking about?
But we weren't as experienced then as we are now, right?
Yeah.
And I think that's part of. I was bringing your brain in to I'd never underwritten at 100%. I'd never taken this risk. I was like, I know if you say no, you're already pedal to the metal past me. So I was like, I figured you would just say yes and I would be the brakes anyway. But I'm like, you know what? At least I can blame you too, right? If it would have happened, I wanted someone on my team to blame.
It's Gabe's fault.
Yeah.
I'm the fall guy.
So when it's successful, there's no one to blame.
It all worked out. It was a great deal.
Yeah.
All right. We're going to wrap this up. You guys got anything else before we go? No. All right. Hey, AJ, if people want to reach out, I know everybody knows how to find you already. What's the best way to get you? Leave a voicemail, send you an email, reach out to your team. How do you want people to find you?
Email's the best way.
And go eat at Clink downtown. Amazing, what is it, French-inspired cuisine, sort of?
French-American. Don't worry. It's plenty American.
It's a beautiful spot downtown in the Forge. There is some construction there, but you can still go eat there. So go have brunch. What'd you call it? Mimosa brunch? You eat a lot of ladies. It kind of feels to me like it's meant for ladies. Like it's kind of
it's feminine.
It's designed for women to go. Yeah.
Everything is designed for the female comfort.
Okay.
It's a masculine color scheme with a feminine feel.
Are you single, Mike?
Yeah, Mike spends every day there.
I think, Mike, you should hang out at Clink. That's where the ladies are.
I'm going to go meet your Well, I know your bartender. He was a nice guy. Yeah, that's a great piece of advice.
Hey.
You're such a visionary.
I'm just helping you out, buddy.
You always want to help me out. I love it.
All right, AJ, thanks for joining us. Deal Junkies, hey, we love you guys. Please share us with someone you love, and we'll see you next time.